whether there's a compositional aspect where people on the higher ends are getting hired and there's a shortage, especially with the retirees, and on the lower ends, perhaps it's a different picture. What's your sense of how much that's contributing to the unexpectedly high rise in wage inflation? Jeff Rosenberg, what's your sense of that? Excuse me.
Sorry, I thought Randy might have been off, but I'll take that. Yeah, you always have to look at the compositional effects here, and certainly there may be some of that, as Mike highlighted, with the retail numbers down and the warehouse numbers down, and Mike, some of that can be seasonal, so that's something we'll have to look in. So there is definitely, when you look at the high frequency data on a month-to-month basis, you can get a mixed shift, and that may be pushing up this number, this 0.55 number. Nevertheless, you know, the bigger takeaway, if you abstract, if you smooth out from the monthly variations, is that the 12-month run rate of wage inflation is still above 5%.
Right.
And so this is really the challenge. And so we're going to get away at some point from this debate about 50 or 75 or really the pace. And the issue is the level of rates restrictive enough? That's really going to be the debate, because right now in the bond curve, the market is expecting rates to be cut by the second half of 2023. So there's a real disconnect between an expectation that we can see the Fed have success on inflation, so much so that they can turn and start cutting rates, versus what we're seeing in the data today, which is none of the impact. Now, there's long and variable lags here, so that's going to make it challenging. But the reality is, and that's what you're seeing in the reaction in the front end of the curve, is that we still have a significant inflation problem in the most important driver of inflation, which is in wages and services.